Yeah. So before I start my presentation, a small disclaimer. This presentation is not any specific advice to anyone in particular, and it may or may not be fully applicable to you because all of you know that advice is very customized. The points which I'm going to discuss here are based on insights I have gathered during my discussions on personal finance with a lot of individuals who have been in different stages of life. So every one of you will have some takeaway or other, and so please stay till the end of the presentation. The purpose of this presentation is to increase awareness about best practices in the personal finance space and how we can, benefit from them. Okay, so moving on, before I go deep into the presentation, let me first try and explain what is personal finance, or when I talk about personal finance, what it actually means. So I went to Investopedia to get a definition of personal finance, and this is what I got. Personal finance is the financial management which an individual or a family unit performs to budget, save, and spend monetary resources, taking into account various financial risks and future life events. Pretty long definition. Let me help you by deconstructing this definition. So personal finance, as you can see, is about managing your money. It's about financial management, and it happens at an individual level or a family unit level. So it's very different than the corporate finance, right? So, but it has a lot of similarities. So it is talking about our own personal money at family level, and the actions which are involved in personal finance is whether you budget your money, you save your money, you spend your money. It is all about that, and you have to do it in a context of the risks you can take and what are your future life events, which are nothing but financial goals, right? So in nutshell, personal finance is about spending, it is about saving your money, investing money, your incomes, and of course about protection, how you're going to protect yourself against various risks. Okay, so now what are the topics which we are going to cover here? So as I promised, we'll talk about 10 topics here. And so the topics are, we'll talk about our risk coverage, basically, which is insurance planning, how to look at it towards our bank accounts, tracking expenses, what we should be doing when we have to focus on taxes, loans and debts, which is very prevalent these days, the investment tools, where you should be investing your money, the residential house, is it an expense or is it an investment, retirement, again a very important topic, estate planning, which is highly neglected these days, and of course what is a holistic financial advice. Okay, so let's quickly move into the presentation, and we start with the first topic, which is about the risk coverage. So what is the common mistake which people do when it comes to risk? So we underestimate the amount of risk in our lives and thus remain exposed to it. So let's understand what actually risk means. Risk is defined as the probability that an outcome will differ from an expected outcome, or in financial terms, when your investments do not give you returns as expected. So this probability of not getting the right returns what we were expecting is risk actually. And therefore we also have risk apart from financial risk in personal life, risk to health, risk to accident, or catching a critical illness. So what we can do? Can we avoid risk? No, we cannot avoid risk. We have to manage risk appropriately. And I'll just give you an example. Suppose I have to travel from one place to another long distance, 20 kilometers every day to go on my job. And there is a risk of an accident. There is a risk I may not reach my office. But does that stops me from going to office? No. What I will do, I will take some precautions. If I'm on a two-wheeler, I will wear a helmet, or I will go in a four-wheeler, or I will take a public transport. So therefore, it's very clear we cannot avoid risk. We'll have to manage risk, right? And insurance cover is the best way to manage your risk in your personal life. And we will talk about it in the next slide. So there are four kinds of risk, and therefore you need to have four kinds of coverage in your life. And the one of the most important one is the life coverage, right? So in life cover, what you have to do is you have to take a decision whether you want to go for a term plan or you want to go for an endowment plan. And endowment plans is nothing but it is a mixture of insurance as well as savings plan, while term plan is a pure risk coverage, or it's a pure insurance. And endowment plans come under many names, money back, whole life, child plan, retirement plan. All these are actually basically endowment plans, right? Now, what is the purpose of insurance? What are you trying to do? Actually, you are trying to secure your family. It is not for you, it is for your family, right? So, because when you are not there, then your family is taken care of, they are paid this money, and therefore, term plans are the best suitable to cover our insurance. You can go for endowment plans, but first ensure that you have a right term plan, and then you can think about saving money in endowment plans. Similarly, when you are ready to take a term plan, the first question comes how much the sum assured should be. So please, there is a scientific method, a mathematical methods to calculate what my sum assured should be, and it varies from person to person. So again, it's a customized effort to find out what my sum assured should be. What should my premium paying term would be? Okay, so please opt for regular payments because they are the cheapest premiums, and you pay as you remain insured for the complete policy period. So this also brings us to a question, what should our policy period be? I have seen people taking insurances for 100 years, 90 years, 95 years, thinking that this is a way, at least something would be available to the family. But this is a wrong approach, because policy should be taken only for your period you have economic value. Means as long as you are working and your loss to the family is economic. Of course, there is a huge amount of emotional loss which cannot be covered through insurance, but the economic value loss has to be covered. Therefore, please only take policy period as long as your working period, and as if you have more liabilities, then you can extend it, right? Because more the policy period, higher the premiums you will have to pay, because you become more risky for the insurance company. Similarly, there are plans which come with a lot of riders. These are add-ons, these are frills, like, and you should avoid them if you do not understand them. And all the riders may not be suitable to you. So please understand it, then they take, because they add to your cost. So after having taken a term plan and a life insurance policy, also take a health insurance policy. Now, most of you might be in corporate sector and may be covered under an employer plan, but it is always advisable to have your own personal plan, and preferably a family floater plan where your whole family is covered under a single plan. Now, why do you need that? See, these days, jobs are not certain, right? So you may end up losing your job, or you may be changing your job. There may be an intermediary period, or maybe your new employer is not covering you on health, or maybe you decide tomorrow to leave job and start your own thing. And also, don't forget, one day you want to retire when the employer cover would not be there. So you need to have your personal plan, and have it early in your life. Why? Because as you grow older, there are higher chances that you will catch any lifestyle disease, and then getting a health insurance plan will result in a higher premium or complete denial from the insurance company. So join early, remain in the plan, then insurance company cannot deny you even if you catch any lifestyle disease later on. Again, here you have to check for some insured, the sublimits, co-payment features, pre and post hospitalization expenses, what are the exclusions, what are the network hospitals. So please take a very informed call. Choosing a health insurance plan is always little more complex than life plan, and now government and the regulator are doing their bit. From 1st of January, they are coming out with standard health insurance plan. All companies will have to come out with those standard, the policy terms would be very standard. You don't have to bother about looking at them, and then you can go and buy from any of the insurance companies. So this is trying to make investors' life easier. So having taken life and health insurance, you can look for an accidental and disability insurance if you have in a risky profession, or if you're traveling a lot, This all depends upon whether you can afford it. If you can afford it, do take them. And finally, the critical illness plan. Critical illness basically means if you catch any big critical illness, these plans comes to your aid by giving you a lump sum money. So check the number of diseases which are covered in the critical illness plan, and don't take it for a smaller amount of 4 to 5 lakh. If you have to take a critical illness amount, take it for at least 20 lakhs, 15 lakhs, so that, because imagine if it is critical illness, you will have to pay a lot of money, right? So that at least you are covered well, at least you are getting 15 to 20 lakh rupees in the problem. Okay, sorry. So it has to be at least for 15-20 lakhs, because once you catch critical illness, you would need this kind of amount, right? Okay, so moving on to the next topic. And if you have any questions, please start writing in the chat box and we will address them at the end. Okay, so next point to cover is I'm going to talk about bank accounts, and all of us have bank accounts. We have savings, we have deposits accounts. So what is the mistake we do here? The second most important mistakes which we are doing is we keep large amount of money in our bank accounts. So all of you can look back and see, usually tend to keep large amount in bank account, whether it is in saving account, whether it is in fixed deposits. Now, what is the reason why we do that? Basically, we are doing it because we want to get a feeling of security, and we think, okay, we may need this money in some emergency, in contingency, so we must have some amount of money in bank accounts. And this is one of the reasons why I keep a lot of money in bank accounts and FD. Some people keep it because they do not know what to do with this money. They do not know where to invest. And some people are simply lazy, they are procrastinating, money keeps on coming, they are on good salaries, there's a cash flows coming in, and the money keeps on accumulating in the bank account. Now, but if we do that, what is the impact? The first adverse impact is that you are losing the value of money, because bank accounts, or it gives you hardly 3%. FDs today are getting only 5.5%. You are not able to beat the inflation, right? You're not able to you are not earning more than inflation. If you are not earning more than inflation, then you are actually losing your money. It's not growing, right? And you are losing also an opportunity to earn extra bucks, right? So there's an opportunity cost to keeping a lot of money in savings bank account and deposits. So what should you be doing? What are the action points? So do not hold money more than 4 to 5 months of your expenses. Okay, so if your expenses are 50,000 rupees per month, maybe 2.5 lakhs is maximum what you should be having in your bank accounts and FDs, right? And if your spouse is also working and there's a double income, you can reduce it further, because then your contingencies are taken care of, because there are two income streams, right? Also, look at liquid mutual funds over bank accounts. Liquid mutual funds, debt mutual funds. Debt mutual funds are better than FDs, because in both these cases, the reward risk equation is more favorable, right? You have lower taxation, right? And they are also less risky. Of course, I'm comparing it with other market related instruments, not banks and FD. But debt mutual funds and liquid mutual funds will give you better amount of returns for the amount of risk you are taking. You get a potentially better tax advantage if you keep on holding them for a longer period, say about 3 years. Then you are in a lower tax bracket, so all due to capital gains, and therefore these are some of the advantages of not keeping a lot of money in savings and deposit and making your money work harder for you. So this is the point which I wanted to make here. Moving on, let me come to the third point, which is about tracking expenses. Now, this is what is the mistake? Of course, the mistake is very obvious. We do not track our monthly expenses. So people have idea what they are spending, but having an idea and having a data in front of you are two different things, right? So what is the reason why we don't track monthly expenses? Obviously we are too busy earning our living. We have no interest. We think this is not important. Some people do start writing expenses, but then consistency becomes a challenge. They become bored after some time, and therefore they get derailed, and they don't track their monthly expenses. Now, what is the impact of not writing your monthly expenses? What happens is you end up spending either too much or too little. Okay, and how do you identify what is too much and too little if you have no budget and if you are not writing your expenses? Similarly, once you are not writing, you are not even able to prioritize your expenses. Maybe you end up spending more on things which are low priority for yourself, and do not spend on things which are of higher priority because you have no idea where you are spending and how much you are spending, right? And once you are not writing, you are also not able to make any corrections. If you want to make corrections, and a lot of people come to me and say, we are not able to save, we do not know where the money is all going, and all this is happening because we are not writing our expenses. So what we should be doing? First is we have to be aware of our expenses. And that awareness will only come if we are writing down your expenses. These days, a lot of free apps are available which you can download on your mobile and keep on writing your expenses. These are customizable apps. You can keep on writing expenses on a daily basis, hourly basis. As you spend, you have your phone with you, you can write there. And at the end of the month, you will get a nice Excel sheet which will give you your expenses under various heads, right? You can do that. Also, as we evolve in our life, as we move from one stage of our life to other stage, we are young, we are not married, then we get married, then our expenses change. Not only our value of expenses change, we have an evolving expense basket. So you can see for a person of 25 to 30-year age, maybe education of kids are not a big expense, but us parents who are at 30s 40s, maybe education becomes the biggest expense. So experience this evolving basket. It will help you to control your expenses. It will help you to be more realistic about future. You will know how your expenses are going to increase 10 years 15 years down the line, and therefore it will be a great advantage to you. Create an expense budget. Now, for those of you who are working in a corporate sector, or even if you are doing your business, you know all corporates have their own expense budget, and you have to take a permission. If you are doing any expenses, you have to see whether it is part of the budget, or you may have to take it. Similarly, create an expense budget for yourself. Here you are going to be your own CFO. You are going to create your own expense budget, and then track your spending vis-a-vis this budget. And now you're not doing this to show it to anybody. It is something very personal to you. You can do it, but it gives you a very good idea whether you are on track. This will help you to understand whether you are spending too much or too. And because your budget is your own, so there should not be any problem in trying to adhere to it. These are some of the points I wanted to mention about tracking expenses. And if you do that, you will be able to understand, or you will be able to save more and understand where you are spending. Okay. Again, my request, if you have questions, you can write in the chat box. Moving on to the fourth point, which is about loans and debts. Now, this is a very important topic, and I will ask you to request you to pay a little attention here. So what is a loan and what is the mistake here? Let's understand the mistake first. We believe living on loans and debts is normal, right? Because everybody you see around you is taking loans. They are on some loan or the other, or everybody is on loan at some point of time in their life, right? So loans and debts have become normal, but actually they are not. And let us take a second to understand what is a loan, right? So I define loan as something, spending tomorrow's income today. जो मैं कल कमाने वाला हूं उसको मैं आज ही खर्च कर देता हूं, ये लोन है, right? और एक और बात है, I did not pay cheaper SIP, which is a reverse of a EMI, yesterday, so I will pay expensive EMI tomorrow. Little complicated sentence. Let's understand this a little bit more with an example. Suppose you have a spend target of 10 lakhs. Suppose you want to buy a car or education or something, you need 10 lakh rupees and maybe 10 years down the line, and you are aware that you need. Now you have two options. You do something about it or you don't do anything about it. Suppose you don't do anything about it, 10 years pass, you come to a stage where you now need 10 lakh rupees. So what will you do? You will end up taking a loan. Suppose you take a loan on an interest rate of 10% for next 10 years, which are about 120 months. So if I calculate the EMI, it comes out to be 13,215 rupees. So 13,000 rupees per month, you will have to pay EMI for next 10 years. Okay. Now look at the other person. What he did something about this 10 lakh rupee target coming in 10 years of down. What he started doing was he started investing in an instrument which gave him a 10% return, and he did this diligently for next 120 months. Do you know how much he needs to save? He needs to save only 4,841 rupees, a difference of whopping 2.73 times. So what are you doing here? Instead of saving 4,800 today, what you are trying to do is you are paying an EMI of 13,000 2.5 years down for the next 10 years. Okay, so this is what loan does to you. Now, why do people take loans? Two primary reasons. One, of course, is that they have lower assets or they have illiquid assets. Sometimes we have not been able to, save or invest so much that we have lower assets and therefore we have no options but to take loan. Or sometimes we have illiquid assets. For example, if I have an asset which is locked, say a real estate, it is locked. Or if I'm putting money in EPFs and PPFs, it is locked 15 years, 20 years, it is locked. And I suddenly need 10 lakh rupees. I can't take that money out here, right? So to stop that, what are you going to do? So you have to be clear. The illiquid assets are not going to help you if you need money in between. Or people take loan because they have higher future income expectations. So they think, okay, आगे मेरी income बढ़ने ही वाली है, इसलिए मैं क्यों ना अभी से ही high spending start कर दूं. Or people get under the influence of zero interest loans. Actually, there are nothing called zero interest loans, but they fall into that trap and start taking it. And of course, when you don't do any planning, it will result in taking loans. So what is the impact of taking loans? As we already saw in this example, they are costly because we are going to end up paying 2.73 times more for the same 10 lakh rupees if we are not planning and if you're going for loan. Similarly, loans are very risky. There is a possibility that you go into a debt trap. Sometimes I've seen people on loans for car, for education. Loans are still not over. They buy a house, so everything is on loan. So they also suffer from EMI stress. And all of us know what pandemic has done to those people who were on a lot of loans. The salaries have been cut. Some people have lost their job, but because they were on EMI, they are more stressed than those who were not on EMI or they were on lower EMIs, right? Another thing loan does is it it removes the fine line between affordability and unaffordability. Because everything is available on loan, we forget what is affordable and what is not affordable. Because everything now comes under the garb of loan and EMIs. So we get misled, we end up buying things or spending money which actually we cannot afford. Okay, so these are some impacts of going on a loan. So what should we do? What is the next action point? First is we must understand what is a good loan, bad loan, and an ugly loan. For example, if you are taking a home loan or an education loan, it's a good loan because you are looking for a shelter, you are investing in yourself, so that's a good loan. But if you are buying expensive cars and gadgets beyond your means, then it's a bad loan because you're buying a depreciating asset and you're going beyond your means. And thirdly, credit cards, if you're rolling your debt after the interest-free period, it is the most ugliest kind of loan. Some of you may be aware that the credit cards charge you as high as 36% to 40% interest if you roll over your debt to the next month. So these are ugly loans, should be avoided, right? Okay, then what should be the points keeping in mind when you're taking loans, right? So interest rate, of course, is very important. You have to decide whether you want to take a floating rate or a fixed rate. So you have to judge whether the economy is the rates are going to fall in the coming years, then you can go for a fixed rate. If it is going to rise, take a floating loan. I'm sorry, the other way around. If the rates are going to reduce, you can take a floating loan. Otherwise, you can go for a fixed loan, right? Also, be wary of your processing fees. It looks very little, but actually, it gives you a huge dent in your EMIs if you go for a processing fees. So keep a check on that. Duration is also very important. If you take a loan for a larger duration, your EMIs may become smaller, but you will be paying much more of interest on that loan. So if for a 20-year loan, you almost end up paying 2.5 times of what you have taken loan on, right? And loan insurance these days, a lot of time you are given an option to take a loan insurance along with the loan. But what I will suggest, if you have an option, don't go for loan insurance, go for a term insurance instead of loan insurance. That would be cheaper. What I mean by that is, if suppose you're taking a 20 lakh rupees loan, take a separate term plan for 20 lakhs. That would turn out to be much cheaper than taking loan insurance, which is pretty costly. Okay. And finally, ensure that your EMIs, whatever loans you are on, should not be 40%, more than 40% of your take homes, right? And always avoid making investments based on loans. Sometimes people come under this impression, okay, I'm getting a loan at 8, 9% or 10%, and I will put it in the stock market. Will I earn 15% for sure? So I must take loan and invest. Please avoid this. It's a very, very risky proposition. So this is what I wanted to talk about loans and debts, and let's move to the next point. Once again, I would request for your questions, please write in the chat box. Okay, so next point of discussion is about investment products or investment tools, or what we call as investment planning, right? So what is the mistake we do here? The biggest mistake we do here is we do an improper selection of the investment product. Means whatever tool we are using to put our money, we do a wrong selection. Now let's try and understand what I mean by wrong selection. And before that, there is a SLR concept in investment. SLR stands for safety, liquidity, and returns. What I mean is, every instrument you can gauge on these three parameters. And let's understand this with an example. I've taken 4 kinds of investment products: fixed deposits, employee provident fund, mutual fund, and stocks. And I have made a grid where I'm judging them on these 3 parameters: safety, liquidity, and returns, right? So what is happening? For example, you can see that when it comes to FD, it is highly safe, green, right? And liquidity is moderate and returns are abysmally low. Similarly, if I take stocks on the extreme end, safety is poor, but liquidity and returns are higher, and so forth, so good for EPFs and mutual funds, right? So what are we going to do is, when we select an investment product, we should be absolutely clear how it is when it comes to safety, liquidity, and returns. Second thing is duration characteristic of a product. What is the duration characteristic? I'll take a minute and tell you. Again, the 4 examples: FD, EPF, mutual fund, and stocks. So as a tool, it is always recommended that FD's money should be parked in FD for very short term. If it is an employee provident fund, money gets locked for very long term. If it is mutual funds and stocks, they should be taken only if your investment horizon is long term, because that is where the volatility will subside and interest rates and you will benefit from the returns, right? So this is what we should be keeping in mind, and therefore it is important that we match the duration. What the mistake we are doing is, there is a mismatch between the duration characteristic of the product and our need for investment, or what is our investment horizon. Now, why do we do that? Okay, sorry. One more mistake we make is too many eggs in one basket. We have seen people who are, if they are investing in FDs and bank deposits, then they're totally into bank deposits. There are, on the other side, there are people who are only investing in real estate, or somebody is only in PPFs and EPFs. So this is also a mistake which we usually do, and we will talk about it in a while. So what is the reason why we are making this mistake? First, of course, is ignorance. The concepts of SLR or duration or asset allocation, risk diversification, these are not known to normally to the people, so they are ignorant. That's why they make mistakes. Other thing is we have the habit of investing on tips. मेरे भाई ने यहाँ इन्वेस्टमेंट किया, मेरे नेबर ने यहाँ इन्वेस्टमेंट किया, मेरे कुलीग ने यहाँ इन्वेस्टमेंट किया, तो मैं भी यहाँ इन्वेस्टमेंट कर देता हूँ. So this is how we as usually invest based on tips, and always we are in a hurry. मेरे पास टाइम नहीं है, जो भी मेरे पास पैसा है वो जल्दी से लगाना है, जो मेरे पास सामने आया अच्छा सा प्रपोजल मुझे लगा, मैंने इन्वेस्ट कर दिया. So these are some of the reasons because of which we end up selecting a wrong product. So what is the impact? The impact is on all these three parameters. Either we end up buying a product which is at potentially higher risk. Our risk propensity के हिसाब से product नहीं है. We are buying a product which is having higher risk, or we are buying a product which has got a lower returns. We could have, if we would have applied some more time and knowledge, maybe we would have got a better instrument which would have given us potentially better returns. And of course, sometimes we without knowing what our goals are going to come in future, we start facing a liquidity challenge because the money gets locked for a longer period of time. So these are some of the impacts which happen. Then what are the action points, right? So what are the actions we should be taking finally to ensure that there is no, we do not make this mistake? First is, of course, we must be investing with purpose. Means whenever we make an investment, we should be absolutely clear what are we investing for? What is the particular financial goal we are going to meet with the help of this investment, right? So if you have a financial goal in mind, then you will be able to know which kind of a product to select, what should be its safety, liquidity, return characteristic, what should be its duration characteristic, and then you will not make a mistake. Also understand that recognize your goal, whether it's a discretionary goal or a non-discretionary goal. Discretionary goals could be, I have to travel, I have to take an international vacation, or I have to buy a car. That's a discretionary goal. You can increase and decrease the value, you can shift the goal. But non-discretionary goals are such, I have to pay 10 lakhs for a graduation fees of my child. Here you have no choice. The timings are fixed, right? Money is not in your control. The fees is not in your control, right? Similarly, there are goals which are long run or short run. Some goals will go to come in 1 year, 2 years, 6 months, 5 years. Some may be 10, 15, 20 years away. So depending upon the type of the goal, again, you will have to do a proper selection based on the duration characteristic. Always, so in a nutshell, always match your investment horizon with a product character, right? And finally, go for balanced asset allocation. Means don't keep all your eggs in one basket. Spread your investments across different asset class so that there is a risk diversification and you gain from all the positivities. In any investment tool in itself is not good or bad. Okay, it is what is suiting us. That is what has to be arrived at. Okay, so this is what I thought I'll share with you on investment products, and let's move to the next point, which is about taxes. Okay, now tax is very simple to understand. So what is the problem? What is the mistake we are doing? We focus too much on taxes while investing. हम जब भी इन्वेस्टमेंट करते हैं टैक्स को सबसे पहले अपने दिमाग में रखते हैं कि इससे टैक्स बच रहा है, नहीं बच रहा है, या मेरा सारा इन्वेस्टमेंट टैक्स के हिसाब से होना चाहिए. दिस इज द फंडामेंटल मिस्टेक व्हिच वी मेक. व्हाई वी डू दैट? बिकॉज वी थिंक टैक्स पे कर देंगे तो हमारे बहुत नुकसान हो जाएगा. टैक्सेस आर बिग ड्रेन. और हम ये सोचते हैं ह्यूज लॉस हो जाएगा हमें, अगर हम बचा लेंगे टैक्स तो हमें बहुत बड़ा गेन है. और ये because of this thinking we always keep tax at the priority when we are investing. Now, what is the harmful impact of this? Actually, we end up losing gains because of tax, we may end up doing a wrong selection. And whatever we covered in the last slide, if you choose a wrong investment, you know what is the impact, right? The liquidity may get impacted. Our returns may go low. It may also turn out to be costly because just because of taxes, we may commit ourselves to a 20-year insurance policy, and therefore the loss in gains is not one time; it is recurring year after year. Okay, so this is the impact when we keep taxes as the priority. So we shouldn't be doing that. So what we should be doing? Always plan your taxes in the beginning of the year rather than always thinking about how to save tax only in the month of March or January when your employer asks you for a detail. Everybody knows you have to pay tax, so please start investing right in the beginning of the financial year. That way you will be able to take a more informed call, and therefore you will select the right product, right? As I said, invest on the merit of the tool rather than tax gain. Okay. And to save tax, whether it is under action 80C, 80D, or whatever, use assorted tools. Don't rely on only one product. Don't only go for EPF. You can go for ELSS, which is a type of mutual fund, which has the shortest lock-in period of 3 years. And then there, for retirement, there is a special tool called NPS, which gives you an extra 50,000 rebate over your 1,50,000 under 80C. So there are a lot of things. Even if you take a health insurance policy for yourself or for your parents, you get a rebate, which is again extra under Section 80D beyond 1,50,000. So you have to keep all these things in mind, plan your taxes right in the beginning of the financial year, and then make your investments. One more important point I want to mention here is that be wary of the new tax regime. Now, most of you must be knowing that there is a new tax regime running parallel to the old tax regime, which has been introduced by the government in the last budget. And what is it saying is that it is doing away with all the rebates, and it's giving you a lower taxation. Now, as of now, you have option to go for both, choose any of the two, which is advantageous to you, but look at the larger message which government is trying to give you. It is telling you in 1 year or maybe in 5 years, we don't know in how many years, maybe the new tax regime is the way to go forward. So please don't start investing only based on tax, because maybe 3 years down the line, the old tax regime may completely vanish and you will end up holding those investments which you had bought only because of the tax advantage, which no longer exists. So uh, be wary of this regime, and keep this in mind when you go for new investments. Okay, so moving on, let's come to another important topic of residential house. So when we are buying a residential house, what is it the mistake we are making? The most important mistake which we are making here is that we treat spending on buying home as an investment. Actually, buying first home where you want to live is not an investment. It is an expense, right? Now, why is it going to be an investment, an expense, and not an investment? See, when you buy one house where you want to live, actually you are not going to sell that house in your lifetime. Maybe your legal heirs are going to sell it, but not you, because you are going to live your life there. So even if it appreciates in value, you are not going to get any gain out of them. So for you, it is not an investment. For you, it is an expense. You are going to pay EMIs or whatever, or a lump sum money, which you are going, actually you are going to consume your house, right? So it's a spend. Now, because of this confusion, what happens? So because of this confusion, we are not able to understand what exactly we need and what is our want. People invest in house thinking, चलो क्या फर्क पड़ता है, investment ही तो हो रहा है, and they end up buying a houses which are much bigger than that, or they are not able to differentiate between the fact that this is an expense and not an investment. So what is the impact? The impact is that we end up buying an inappropriate house. Either size wise, we buy more than what we need, or we take a location which may be, very far from our working place, or maybe in a very high end area, and we pay more. And if you pay higher capital, your EMIs also rise, and therefore it has an impact for next 15-20 years if you're on loan. And buying a bigger house may also have higher operational costs. You may have to pay more maintenance. You have to pay more on electricity. Everything goes up. So be very clear that you are not making an investment when you're buying your first house. Buy it is a spend, and only buy what you need, not go beyond your needs, because it will have a costly impact. So what is the action point? As I said, be clear. Living house is not an investment. It is only a spend. Again, as I said earlier, please ensure that you limit your EMIs to 40% of your take homes. And sometimes people are also buying a house beyond the house they are living. So you have to think really hard whether a residential house is really a good investment. It can be, but just I want to give you certain pointers. The rental value on a residential house is anywhere between just 3 to 4%. So if I buy a 1 crore flat, maximum I'm going to get is 25,000 rupees or 30,000 rupees as a rent. So 3 to 4% is what I'm going to take. Of course, it will have some appreciation, but again, if you look at the long-term appreciation, it is only 5 to 6%. Even you have seen flats after 15, 20 years, instead of appreciating, they start depreciating. Okay. And risk involved in buying a real estate is real. All of us know this now. When the builders are not completing, whatever has been promised is not being given. So don't think that because I'm buying a real estate, I can see it and I feel more secure, but there are more risks, liquidity is stuck. Now, this, what I'm saying, is not necessarily true for every case, but whether it will appreciate well, will it give you good rental value, is dependent in so many external factors which are not in your control. यहाँ मेट्रो लाइन आ जाएगी तो रेट बढ़ जाएंगे, लेकिन यहाँ पे अगर अथॉरिटी का इन्वेस्टमेंट कूड़ा डालने का डंप क्रिएट हो गया तो उसकी घट जाएंगे, ये हमारे कंट्रोल में है नहीं, right? So please be very, very clear and very, very careful when you're trying to put a lot of your hard-earned money, and it's a big investment which has a huge impact in buying a house. Okay, right. So moving on to another important point of retirement goal. So what is the mistake here we make? Mistake number 8. We neglect the most important goal of our life. And now we must understand, actually retirement goal hota kya hai? Why am I calling retirement as a goal? I'm here talking about retirement corpus. Retirement corpus is a money which you require when you retire. Now, all corporate guys are going to retire at 55, 60, 65. It is fixed for them. Business people can say, okay, I don't have retirement age, I will extend it for some. But inevitably, one day everybody has to retire, and therefore he has to have a corpus. For example, if I retire at 60 and I live up to 85, I have to fund myself for 25 years. There are no pensions in private sector. There are no pensions for a business person. There are no pensions even now even for the government employees, right? So you have to fund yourself. This is the retirement corpus I'm talking about. And why is it a most important goal of a life? 2 reasons for that, right? What are those 2 reasons? The first reason is this is the biggest goal of your life. You will need couple of crores, if not crores in double digits, right? No other goal is so big. That's why it's one of the most important goal. Many, many crores you need to fund yourself. The second important thing why it is important is that nobody is going to give you loan for this goal. You want any other goal? Car loan, you get home loan, एजुकेशन करनी है लोन, सब चीजों के लिए लोन है, पर्सनल गैजेट्स के लिए लोन है, बट रिटायरमेंट के लिए कोई लोन नहीं देता. At the age of 55, you go to bank and ask, please give me loan. 5 years down the line, I'm going to retire, give me 5 crores. Nobody's going to give you loan. So this is a goal where you have to fund yourself, and it's a very good goal. That's why it's very important goal. Now, why do we neglect this? Because we think it's too far away. अभी 25 साल पढ़े हैं, अभी क्या बात करनी लोन की, गोल की, इस रिटायरमेंट की. 10 साल है, 5 साल है, we don't want to talk. That's the reason. Or some people think we will never retire, especially people who are doing their own work, business. They think we will continue till long. But God forbid, if your health does not permit you, 20, 30 years down the line, the businesses you are in, we do not know whether they will still flourish or not. It's a very dynamic situation. So everybody has to retire. Some people have never thought of retirement as a goal at all. So that's the reason why this goal gets neglected. So what is the impact? The biggest impact of retirement goal is that we end up having a prolonged work life. Of course, we have seen people after retirement, they also take up a job. Okay, if they are doing it for their, as a pastime or keeping themselves busy, it's fine. But if you are doing it just because you want to earn living, because you have not accumulated, this is the biggest impact if you do not plan for retirement goal. You can have a decline in the quality of your life. You may not be able to give to your family or to yourself all those monetary resources which you were doing earlier, because that time you were working, right? Or it may lead to dependency. It could be dependency on your children, or it could be on anybody else, right? So these are the impacts if you do not take care of this most important retirement goal. Now, what are the action points? So first is start early. Why we need to start early? Because if we start early, we get the advantage of power of compounding. And we have already seen that we need to collect couple of crores. So we have to start early. And let's understand this power of compounding with an example. So there is one Mr. X who is of age 25 and he wants a retirement corpus of 5 crore when he retires at the age of 60. So he has 35 years to go, and which is equivalent to about 420 months. So what he does, he start investing that money again in an instrument which gives him a 10% return, monthly investment. And therefore the calculation shows that if he invests 13,000 rupees for next 10 years, next 35 years at 10% interest, he will reach his goal of 5 crore. So when he comes to know this calculation, Mr. X gets very excited. He runs to his brother and says, you must also do that. So his brother, Mr. Y, also needs 5 crore, but unfortunately, he's 10 years elder. He's of 35 years. So his time left is only 25 years to retire, which is 300 months. And he also starts thinking of investing in the same return of 10%. But to his astonishment, he's told that his monthly investment requirement now is 37,000, a difference of 3 years, 3 times almost, just because you are starting late by 10 years. So you can imagine what the impact of power of compounding has if you start early. Against 13,000, a 10-year late, you have to put 37,000 per month. Okay, so this is very important to understand. Next is use mix of assets. So when you're creating a retirement corpus for yourself, don't go for only risk-free instruments like employee provident fund and public provident fund. You should have a mix of all. Take advantage of mutual funds, which are risky, but at least they give you a better return, and the risk can always be managed with the help of an advisor, right? Or go for a specialized product like NPS, which is the National Pension Scheme. Because if you are not taking risk, as the saying goes, not taking risk is also risky. What's the risk? You may end up not achieving your corpus. That is also one type of risk. Okay, so please have a mix of assets so that you get advantage of higher returns as well as some base money is in risk-free instruments, right? And finally, do not touch this corpus. What I mean by this, there will be a lot of temptation as you go about building this retirement corpus to take out this money and spend it in some goal in the middle. It could be education of your kid, it could be some foreign travel, right? But please avoid this temptation, because for every other thing you will get loan, but for retirement, nobody is going to give you loan. So don't touch this corpus and avoid this temptation. Moving on to the second last point, which is about estate planning. So what is estate planning? Estate planning is basically we are trying to talk about how your investment assets or whatever you have accumulated over a period of your life, working life, how you're going to pass them on to your legal heirs with efficient and with ease if something happens to you, God forbid, right? So that is what estate planning is all about. And here we talk about will and all things. Let's first understand what the mistake. We knowingly or unknowingly expose our family to distress. So what happens? You have seen cases, you must have seen cases, some family members or in your network, people expire suddenly or due to some reason, and then their family does not know where the investments are lying. They do not know how to claim those investments. They run pillar to post. They go into lengthy litigations in court to prove that they are the legal heirs. And that is how not only your family is suffering from an emotional loss, they also get into financial mess just because you did not do the estate planning. Okay. Now, what is the reason why we don't do? Because we are ignorant of this fact that yes, we have to take care of this. And thinking about our own demise is a very, very unpleasant thought. So we don't want to do that. Or we think it's not important. Dekha jayega, right? So these are some things, reasons why we don't do estate planning. Now, what is the impact? As I said, stressed family. Already they are emotionally stressed. Now they are financially stressed. It becomes very costly for them to go after litigations or do a lot of paperwork gets involved, a lot of time gets involved. It becomes highly inefficient exercises. So all this impact creates a big mess for the family if you are not doing estate planning, right? Finally, what are the action points? So first, of course, is prepare a will. More your assets, more prepare. It is said You must prepare a will the moment you own the first asset, and it's not necessarily when you own a property. It could be a simple FD, it could be a simple mutual fund, it could be anything. It's your asset. Prepare a will, and will can be changed number of times. Go to a qualified lawyer, he will help you to prepare a will. Or ensure make all your investments are in joint names on either in survivor basis. Check whether you have done nominations in each and every investments you have done. And if you are looking at very large assets, you can create trust for your minor children. These are very tax efficient, but it's a little complex. You will have to take a advice or a service of a lawyer who can help you create trust. So keep all these things in mind when you have to create an estate plan. Right? And now we come to the last point of our discussion today, which is about holistic advice. Okay, so what's the holistic advice? Let me take you through. So what is the mistake here? We mostly rely on advice which is free and widely available. Tips, correct? You remember my word, tips, right? Because it is free and widely available. What we forget is the advice trustworthy? Is the advice unbiased? Is it conflict free? Is it in your interest? We forget all that and we only look at an advice because it's coming free and because it is widely available. It is very easily available. हर left right में हमारे जो रहते हैं हमें advice देते हैं, right? कि यहाँ invest कर दो. So this is again a mistake which we are mostly doing. Now, what is the reason? Why do we make this mistake? Okay, again, guys, just to tell you again, please keep on writing your queries in the chat box so that we can do, and we're just about to finish after this slide. Okay, thank you. So reasons are, again, as I said, we have the habit of investing based on tips. We want short and swift solutions, right? इतना कौन दिमाग लगाए, जल्दी से बताओ कहाँ लगाना है पैसा, मैं लगा देता हूँ, right? So we want short, and we also looking for returns also very in a short term. We don't want to do long term investing. Herd mentality, उस जैसे मैंने कहा, उसने किया, दूसरे ने किया, तीसरे ने किया, तो मैं भी यहाँ करता हूँ. Because most if the सारे कर रहे हैं तो सही ही होगा, मैं भी कर देता हूँ. और because ये advice तो free है, इसमें क्या फर्क पड़ता है, ले लेते हैं, कर देते हैं, right? So these are some of the reasons based on which we take these advice and we do the investments accordingly. But what is the impact? Same thing. Advice can turn out to be free. Advice can turn out to be very costly. You will come to know later on that it was actually not in your interest. It was in some third party interest, right? And it can harm you in long run. So don't go for this. What you should be doing? Always prefer a holistic advice over a transactional one. So if you meet people on a transactional basis, ओके एक पर्टिकुलर शॉर्ट डोमेन में चाहिए, शॉर्ट टाइम के लिए उसकी एडवाइस ले ली, कल दूसरे की ले ली, परसों तीसरे की ले ली, तो ये ट्रांजेक्शनल एडवाइस है. डोंट गो फॉर दैट. गो फॉर अ होलिस्टिक एडवाइस व्हिच विल कम इन अ with a longer perspective in mind, which is more client centric rather than product centric. Most of the advice which we come as a free advice is product centric advice. As I said, separate advice from product, right? And before that, let me tell you, go for paid advice. Why? Because it will ensure accountability and loyalty. जो आपसे पैसे लेके आपको advice दे रहा है, वो आपकी तरफ accountable है, उसकी लॉयल्टी आपकी तरफ है, बिकॉज आप उसको पे कर रहे हो, ना कि कोई थर्ड पार्टी उसको पे कर रही है, राइट? सिमिलरली सेपरेट एडवाइस फ्रॉम अ प्रोडक्ट, एंड यू कैन लुक एट एन एग्जांपल ऑफ अ डॉक्टर एंड अ क्लाइंट, right? What does doctor do? Doctor gives you an advice, and what do you do from medicine? You take a product, and I mean you buy the medicine as a product from a chemist. So please separate advice from a product. It will be more of it will help you avoid conflict of interest, right? So keep this in mind and take an advice from a professional rather than going for tips. So this is all what I wanted to cover today, the 10 topics. I hope you enjoyed it. So if you have questions, we'll take the questions now, and if whatever queries you have, you can also unmute yourself after my talk, and we can take these questions. You can also write to me. You can connect with me at my emails if you want to discuss few other points with me. If you want to understand what I do, if you want to know more about financial planning, you can connect with me. I am also on social media. I also make small YouTube videos on my YouTube channel, Dhantripti Financial Planners. You can go through it, and I am always available to you for any queries and things. So thank you again, guys, for your patience. We can take some questions now.